Meanwhile, the Fed's preferred inflation gauge for August in line with expectations. Core PCE holding at 2.9% on an annual basis. Our next guest, though, still thinks the Fed has an inflation problem. CNBC contributor Peter Boockvar is the chief investment officer at 1 Point BFG Wealth Partners. Peter, good to see you. It seems sort of stuck, and this sort of limits what the Fed can do because they still have to be vigilant on the inflation front, correct?
The biggest problem that lower to middle income consumers have is the cost of living. And with the 2.9% core PCE, an effective Fed funds rate now at 4.08, and in the dot plot, a long-term 1% real rate, they're basically there. Give them one more cut, and they're at that 1%. Now, that means that if they're going to cut further from there, inflation has to decelerate, or if the unemployment rate starts to rise and they say, you know what, a 1% real rate needs to be a half or a zero. So I think the market got carried away with what the Fed's going to do under Jay Powell. Now, once he leaves, all bets are off and they can do anything. But at least through May of next year, I see maybe 1 or 2 if inflation's still stuck at 3%.
So just to extrapolate that would imply that there is a disconnect between market expectations and what the Fed can actually do given the situation they are in. And so therefore, we are due for a pullback? I mean, is that sort of is that the bottom line here?
Well, if you look at the two main factors for the stock market rally, the AI tech trade got a second wind, and the Fed's going to cut, you have to buy stocks, particularly small mid-cap, which played catch-up. So I do think if there's going to be a reason for the pullback, it's the AI tech trade that's exhausting itself. I think Oracle was a good example of that on that one-day spike, and it's down 50 cents, and the realization that, yeah, maybe we're, and I refer to as a rate tweaking cycle rather than a rate cutting cycle.
I read you religiously. Beginning of the year, you said the data this year is going to be lumpy, messy. It's not going to make a lot of sense. Tim mentioned consumer spending was robust in August, in a word. The unemployment rate seemingly going the wrong way. I mean, there's a lot of things here to parse through. But to your point about inflation, is the bond market back on its horse like it was last September?
I think we have the early signs of it. But you also had this week, you had multiple Fed members saying, hey, wait a second, market. We're taking this meeting by meeting, maybe 1, 2 tops. So I think there's an adjustment there. But yeah, 3% is much different than 2% inflation, especially when you compound that and what that means for interest rates across the curve.
So where do you think real rates should be?
Well, I'm always of the belief that interest rates should be above the rate of inflation. The Fed thinks the long term should be 1%. Great financial crisis, it used to be 200 to 300 basis points. So if you look at Steve Myron, he thinks they should go to 0 right now. That's quite extreme. So I think we have a healthier economy when we have positive real rates. And right now, it's about 1%-ish.